So, HIMS just crashed 41% from its peak, and I watched institutional investors bail out during the earnings pop like rats abandoning ship. The costly mistake? Panicking and selling right now. The opportunity? Understanding why this washout might be your entry point. Look, if you're short on time, or you're not convinced you should listen to some random guy with a cat-themed channel, here's what matters. HIMS is trading at $42 in deeply oversold territory after a guidance reset that spooked the market. But management has actually quantified and dated every single headwind they're facing. This isn't open-ended deterioration, it's a temporary growth deceleration with a 6 to 12-month recovery horizon. The risk-reward at current prices is most likely in retail investors' favor. Now, whether you accumulate here or wait, that's on you. But stick around if you want to understand the fundamental and technical picture after the Q3 earnings call. Hey, I'm DataCat, for those who are new here, and yeah, I know the name is ridiculous. So quick background, since this channel is only about 3 months old and, I'm still figuring out this whole YouTube thing. I spent years working as an analyst inside a Fortune 50 company. Think messy data, endless meetings, Confluence documentation no one ever reads, the whole corporate grind. I eventually traded that life for, lasers and keyboards, and honestly, I'm just trying to share what I learned without the corporate jargon that makes your brain melt. I'm not here to pump stocks or sell you courses. I'm just some guy who happens to find this stuff genuinely interesting, and I figured maybe some of you do too. Plus, cats are naturally skeptical creatures, right? Sometimes the best move is to sit back, watch everyone else panic, and then pounce when the opportunity actually makes sense. Though, let's be real, cats can also be pretty mean and sarcastic when people don't smash that like and subscribe button. Anyway, HIMS. This one caught my attention because the market reaction felt emotional. And emotional markets create mispricings. Alright, so let's talk about what just went down with HIMS after reporting Q3 earnings. They actually beat expectations. Revenue growth of 49% year over year. Strong EBITDA. On paper, this should have been a win, right? And initially, the market thought so too. The stock gapped up 3% at open, hit a high of $48, and early buyers were feeling pretty good about themselves. Then the gap and fade happened. By close, the stock was down over 3%, finishing at $42.79. That's over 11% below the intraday high. Volume was double the average. And this wasn't retail panic selling, this was institutional distribution. Big money used that earnings pop as an exit door. From a technical standpoint, this was brutal. The stock is now down 41% from its $73 peak. It's broken key support levels, 15 down days out of the last 20. Lower highs, lower lows, textbook downtrend. The MFI is at 12, which is extremely oversold. RSI at 36. Stochastic at 3.42. Which is basically capitulation territory. So naturally everyone's asking, is this thing dead? Did the growth story just fall apart? Should I cut my losses and move on? And that might exactly be where the opportunity is hiding. Okay, so why did the market freak out? Let me walk through the bad news that triggered this sell-off, because understanding this is critical. First, growth deceleration. Third quarter revenue growth was 49%, fourth quarter guidance, 28% at the midpoint. That's a massive slowdown, and growth investors hate decelerating growth more than cats hate water. Management blamed 3 things: sexual health transition drag, GLP-1 weight loss shipment cadence issues, and price cuts they made to stay competitive in the weight loss space. Second, margin compression. Third quarter EBITDA margin was 13%. Fourth quarter guidance, 10%. Management actually used the phrase temporary pause in margin expansion through 2026. Translation: they're spending aggressively on new specialties, international expansion, and infrastructure. Investors heard pause and margin compression and hit the sell button. Third, the GLP-1 uncertainty, not exactly news. HIMS has been riding the weight loss wave with compounded semaglutide. But Novo Nordisk partnership is still in active discussions, not finalized. The FDA shortage that allowed compounding could end. They cut prices by 20%. Generic semaglutide is coming in 2026. So there's this fear that the golden goose might be temporary. And fourth, the technical breakdown amplified everything. When you've run up 305% from lows, you're vulnerable to profit taking. Once the downtrend confirmed, momentum traders piled on. Algorithms started selling. It became a self-fulfilling spiral. So yeah, I get why people are scared. On the surface, this looks like a growth story hitting a wall. But here's the thing. Markets are really bad at distinguishing between temporary headwinds and permanent deterioration. And here's why. Every single headwind management mentioned, they quantified it and dated it. This is not some vague, challenging environment corporate speak. They literally told you when each issue resolves. Sexual health transition dragging HIMS brand growth, fully lapped by second half 2025. GLP-1 shipment cadence mismatch creating a $20 to $25 million fourth quarter revenue drag. Normalizes in Q1 2026 when cohorts stabilize. Weight loss price cuts pressuring margins, offset by verticalization savings in second half 2025. Investment cycle compressing EBITDA margins, leverage kicks in through 2026. Now, contrast this with what's actually ramping. HIMS is building multiple new growth engines right now, and this is what the market completely ignored. Testosterone. Management said this has immediate product market fit. The total addressable market is tens of millions of men. They have a partnership with Marriott Pharma for FDA-approved oral testosterone launching in 2026. This is high margin, non-stigmatized, and solves a real problem. Menopause through their HERS brand. 1.3 million women enter menopause annually in the US alone. Only 30% of OBGYNs are trained to treat it properly. The HERS brand is approaching $1 billion in revenue. This is a massive underserved market. Diagnostics. They're launching advanced diagnostic testing now. We're talking $5,000 to $10,000 tests that they can offer for a fraction of the cost. This creates a non-stigmatized customer acquisition funnel. You come in for a health screening, they identify issues, then they offer treatments. It's brilliant from a business model perspective. Longevity. High average selling price, affluent demographic, peptide manufacturing facility already operational. This launches in 2026, and then there's international. Canada launch is imminent. 67% of Canadian adults are overweight or obese, and generic semaglutide hits there in 2026. Europe, through their Zava acquisition, is already at a $50 million plus second half run rate, and management is deploying capital aggressively. They've said publicly the international opportunity is worth over $1 billion in revenue potential. Oh, and by the way, they have $1.1 billion in cash and investments on the balance sheet. They generated $79 million in free cash flow in Q3 alone. There is zero existential risk here, even if weight loss completely stalls. So what you have is a company in a temporary investment cycle that's building the infrastructure for its next phase of growth, and the market is treating it like the wheels are falling off. Classic short-term thinking meeting long-term opportunity. Kind of like when a cat knocks something off a table just to watch everyone freak out. Chaos for them, entertainment for us. Now, of course, I'm not going to sit here and pretend this is a risk-free layup because it's not. Let me walk through the actual risks, because if you're going to make an informed decision, you need to know what could go wrong. Risk 1. Fourth quarter results disappoint again. Earnings are likely coming in early February 2026. If new specialties don't scale as fast as management expects, if weight loss weakens further, if guidance gets cut again, that would validate the bear's thesis, and you could see this stock test the $35 to $38 range. That's roughly 15% more downside from here. Risk 2. Margin compression is worse or lasts longer than guided. If the investment cycle extends beyond 2026, if verticalization savings take longer to materialize, EBITDA margins could stay depressed. And if margins stay low, the valuation multiple contracts. Growth without profitability gets punished in this market. Risk 3. Macro deterioration. We could hit a recession. Discretionary healthcare spending could drop. High beta growth stocks could remain out of favor for an extended period. This might be the right story at the wrong time, and timing matters when you're trading with a 6 to 12 month horizon. And risk 4. Apparently, management could just be wrong. They could be overly optimistic about new specialty adoption. International expansion could take longer to scale. The compounding business could get hit harder than expected. Execution risk is real. So this is not a set it and forget it situation. You need to be willing to monitor this closely, especially around the next earnings release. Alright, so what do I think you should actually do with this information? Remember, this is not financial advice. I'm just a random guy who cuddles with cats. If you're a long-term investor with a 6 to 12 month horizon, current prices represent an accumulation zone. 42.79 is 41% off the peak on a guidance reset, not a broken business model. The fair value is estimated in the $55 to $65 range. That's 30 to 50% upside if the thesis plays out. Now, the way I'd approach it, scale in gradually. And let me explain why by walking through the technical setup again, because this matters for your entry strategy. Right now, HIMS is literally testing the critical support and recent low at around 42. If that breaks, the next major support zone is around $38 to $40, which was a prior consolidation area before the big run-up. On the upside, you've got resistance at around 47. Above that, you're looking at $49 and $53. Each of those levels represents a battle zone where sellers are likely waiting. The stock is trading 12% below its 20-day EMA and 7% below its 50-day SMA. That's a significant distance, which tells you the momentum is clearly negative right now. The OBV slope is negative too, which means smart money has been distributing, not accumulating. Here's the thing though, both the RSI and MFI are in oversold territory. Stochastic at 3.42 is basically capitulation. The Bollinger Band Z-score is negative 1.42, meaning we're riding the lower band. Historically, when you get this many oversold signals stacking up, you're either near a bottom or you're about to see a dead cat bounce before more downside. So tactically, here's how I'd play it. Don't try to catch the exact bottom, because technically this stock is still in a confirmed downtrend. 15 down days out of the last 20. Lower highs, lower lows. The trend is your enemy right now. You could absolutely see more chop or even a flush down to that $38 to $40 zone if panic selling intensifies or if we get negative news flow. What I do is scale in over the next few weeks. Maybe start with a small position here around 42 to 43. If it drops to 38 to 40, add more. If it bounces back above 47 and holds, that's a potential trend reversal signal, and you could add on confirmation. The point is to build your position gradually, so you're not trying to time perfection. You're averaging into what you believe is a mispriced asset, while respecting that the technical damage is real and could get worse before it gets better. And then you wait for the catalyst. Fourth quarter earnings would be the inflection point. That's when you'll know whether new specialties are gaining traction, whether weight loss has stabilized, and whether management's margin compression timeline is credible. If they deliver, you'll likely see a technical reversal. You'll get a higher low, then a higher high, and momentum will shift back in the bull's favor. If they miss, well, you reassess and potentially cut losses. The key is understanding that right now, the technicals are bearish, but the fundamentals suggest this is temporary. You're betting that the market is overreacting to short-term noise and missing the bigger transformation. Sometimes the best trades happen when everyone else is running for the exits. That's when cats pounce. But you pounce strategically, not recklessly. Alright, that's my take on HIMS. And again, this is not financial advice. I'm just some random former corporate analyst who traded spreadsheets for YouTube. Do your own research. Understand your risk tolerance. Don't invest money you can't afford to lose. If you found this breakdown helpful, I'd appreciate it if you hit that like button and subscribed. Seriously, it actually helps the algorithm show this to more people who might find it useful. And if you want me to cover a specific stock or topic, drop it in the comments below. I actually read those, even though I'm terrible at responding because, introvert things. Thanks for watching. I'm DataCat, and I'll see you in the next one.